Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Kelly Rodriques, CEO of Forge Global, a private securities marketplace, to discuss performance in the private market and if a recovery is on the way. Kelly, it's great to have you with us. Welcome to Trade Talks.
Thank you. Great to be here.
You got it. Tell us about Forge and what you've been working on.
So we're a leading global private securities marketplace, trade several hundred private companies around the world. We also have a data product called Forge Intelligence, which tracks pricing, real-time IOIs and data. And we hold a qualified custodian with about 2 million private market investors. And lately, I guess most recently, as of yesterday, we launched the Forge Private Market Index, which is an index product we've been working on for a while, which tracks and uses live real-time trading data for the top liquid companies in the private market space, 75.
How would you characterize performance of the private market today? Do you think there's a recovery on the way?
Gosh, we all hope so. We're down about the valuations, and the data that we're tracking shows valuations off by about 48% over the last 12 months, about 17% year to date. And one of the things that we've been publishing for a while is that large private tech does correlate with some of the discounts and multiple compression that you've seen in the public markets. It just takes time. So there's been latency in catching up, but now we're there. And like everybody else, we're watching what's going on. And there are 2 or 3 indicators that we do track that big investors are now watching carefully to try and gauge whether we're at the bottom. I'm happy to go there if you'd like.
Yeah, oh, for sure.
So we look at, first of all, what is the bid-ask spread looking like relative to the last 12 months? And that's compressed to about 21% from a high of 28. We're also seeing a leveling off of discounts. So trades that are actually happening now are about 50% of their high from back in 2021. And that's been consistent for about 6 months. So the pricing is not dropping any further. And finally, and this is an interesting one, companies that are buying back their stock. There are right of first refusal provisions in many of these deals. And right now in the last quarter, we've seen buybacks at about 12% of the liquidity. And that's unusual. That normally tracks at about 6%. So these are all indicators that investors are watching to call the bottom.
What's been the impact of interest rates on the private market? We know capital has clearly gotten more expensive. Well, what else is going on there?
Well, if you think about the impact of interest rates to the broader public markets, it clearly have been down as interest rates continue to increase. Now we're seeing, as everyone else is now, a more moderated increase in rates. And many believe that the end of the year has been priced into the current securities pricing. We're watching that. And we watched Powell the other day and feel like, not unlike the public markets, privates will be affected by a decrease in rates and a turnaround. Everyone's hoping for the end of the year, but we'll see.
Let's talk about employee retention for a moment here. What are you seeing in terms of demand from employees to sell their stock, and how are layoffs affecting that demand?
Boy, this is the perfect storm. We've been talking for years about how liquidity programs are really important for retention of employees. Right now, that's still true, but what's also true is during layoffs, people need some of the cash that they've earned through working for a private company for years to manage their transition. So many companies are being proactive, lowering the valuation and supporting those liquidity programs. And so we see this as a moment where there's a real reflection in the market about whether companies should be proactive or not in managing down their valuations. If they're raising capital, they're going to be forced into it. And if they're not, then it's a decision that they'll make to serve the employee retention and obviously that transition.
Kelly, it's interesting. In the course of our coverage, we've noticed that investors are looking for younger companies. Why do you think there's that shift to younger unicorns?
Well, it's important because people ask me the question, are they going into smaller unicorns? And that's not the case. I think what's perceived in the market is a younger unicorn that's still big, that's not going to be public for another 3, 4, or 5 years, has more upside. There's more headspace in their private valuation if they're not planning on going public. many of the older unicorns were gonna go out in 22 or maybe 23, but the window's closed. So I think a lot of the sentiment is shifting towards younger, larger unicorns.
All right. We appreciate the insight, Kelly. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.